What if I told you many investors are being sold a lie? A lie that sounds safe and reliable, but it might not be as advantageous in the long run. This lie is called dividend investing. As time and time again, you've been told to buy dividend stocks so you can feel secure and earn steady passive income. But in reality, this advice might actually cost you a lot more than you think or don't even know about. So in this video, I'll walk you through things that they don't tell you about dividend investing and why you should be cautious, especially if you're a young investor. What are dividends and growth stocks? Before we dive into the video, let's get the basics right. There are two types of stocks that we'll focus on in this video. The first one is dividend stocks. These are stocks of companies that pay regular cash to their shareholders just for being a buyer and holder of their stock. These companies are generally mature, stable, and sometimes even slow growing. The second type is growth stocks. These are companies that reinvest their earnings into their business expansion, such as research and development, marketing, and business scaling. The main idea behind investing in them is compounded capital appreciation. Their stock price rises over time as the business grows, giving good returns to investors. But volatility is a major factor and returns aren't guaranteed. Why dividend investing is often oversold? Sure, dividend investing sounds great. All you have to do is invest into relatively stable companies and you earn passive income. What could be better than getting paid to sit around and do nothing? But several hidden costs may actually be costing you a lot without you actually even realizing it, especially if you're young and starting your investing journey. So let's take a look at the 4 red flags of dividend investing. Number 1, future lower upside. On average, the dividend yield of a good, healthy company ranges between 2 to 4%, combined with modest stock growth. Generally, dividend-paying companies are at a more mature state and not growing as much. When companies give out cash, that money is not being used to improve their product or increase their growth. That money could have been used towards research and development or marketing. That's why some of the most successful companies, such as Amazon and Tesla, don't pay dividends, since they reinvest every dollar back into their business and relentlessly focus on growth. If Tesla paid a dividend, they wouldn't be able to build factories or attract the best talent. Only recently, last year, Google and Meta just started paying a dividend despite being some of the largest companies in the world. Young investors who held onto their stock saw massive returns, but those who prioritized getting cash lost out big time. Growth stocks gives a return of 10%, 20%, or even 30% in a good year. Now, when you compare this over decades, those differences multiplies and makes a huge difference. Number 2, bias toward safety. Dividend stocks do offer less volatility, but when you're young, volatility isn't really bad because you got time to recover. Being able to stomach large dips allows you to take riskier approaches with growth stocks, which can appreciate much higher and faster compared to dividend stocks. Number 3, hidden risks in dividend yields. One of the biggest traps that people overlook are unprofitable companies that pay high dividends. If you peel back the onion, this really just means that the company is in distress or financially unstable. Some companies maintain this high dividend yield to attract unsuspecting investors who are simply chasing high yields. Or they do this to become a more popular stock amongst dividend-focused investors because all they see is a big fat dividend yield number and they're sold. A perfect example is Icon Enterprises, IEP. They've been consistently losing money for years, and the stock performance has been falling consistently, but they offer a 24.5% dividend yield. So if you don't do your due diligence, dividend investors may only just focus on that specific number. This is a major red flag to be cautious of. Number 4, no promise of dividends. Dividends are purely voluntary, meaning companies are not legally bound to give dividends to their shareholders. They only do this to attract more investors or retain their existing investors' interest in the company. If a company doesn't want to give out dividends, there's literally nothing stopping them from doing so. Math comparison. Now, let's take a look at a comparison side by side. A dividend ETF versus a growth ETF. For the dividend ETF, we'll use the crowd favorite SCHD. And for the growth ETF, we'll use QQQ, which is in NASDAQ 100. These are the parameters. We'll invest $10,000 at the start of 2012 into both SCHD and QQQ. Then we'll compare how much money you'll have in both with dividends reinvested. Using this tool from dividendchannel.com, we could punch in our parameters and here are the results. 10K invested into SCHD from January 1st, 2012 to today would have grown to $47,564.28 with dividend reinvested. that same $10,000 into QQQ would have grown to $117,201.36. That's almost 2.5 times more than SCHD. If this makes sense, please do me a quick favor, hit that like and subscribe. It helps out way more than you think, and it keeps me motivated to keep making free content for you guys. Why growth investing is better for young people, and when does dividend investing make sense? If you're young, your priority should be growing your investments because you simply have more time. When you're young, you could afford to take on more risks to ride out any volatility or even crashes. Someone in their 60s doesn't have enough time to recover from that same crash. Now, to be fair, I don't want you to think that dividend investing is completely useless, because it's not. It has its own upticks and works well for others or in the situations that they're in, especially if they're old. Now, here's when dividend investing makes sense. You're either close to or in retirement and require additional source of income. You already have a large portfolio and want to reduce your volatility. You want a predictable cash flow that is less dependent on selling shares. And you either prefer lower risk and you simply can't tolerate large drawdowns. Common lies that you've been sold about dividends. Now, while we're at it, let's bust some myths about dividends. So let's take a look at common misleading sales pitch and why they are different in reality. Number one, you need dividends as passive income. Sure, I get it. Who wouldn't want extra income without any hard work? But unless your capital base is huge, your dividend income that you'll be earning is quite tiny and you won't be making much of a difference. And unfortunately, many people on the internet overestimate this. Number two, dividend stocks are less volatile. Now, there is some truth to that, which I completely agree with. But growth stocks does bounce back even harder as long as the fundamentals are strong. So, as long as you have a long-term horizon, you typically always make up for all the losses plus some more. Number three, you'll regret not having dividend income when you're older. Now, you can always shift to dividend paying stocks later in life, especially when you made the most out of your growth stocks. The best way to look at it is when you're young, you should be focusing on wealth accumulation. When you build up that nest egg, then you could shift towards wealth preservation, which is dividend investing style. How can you build a smart strategy as a young investor? No matter what, no growth is risk-free, as there's always going to be some percentage of risk involved. And that's why whenever you're investing, there's always a few key things to keep in mind that will increase your chance of success. And these are diversification. Never keep all your eggs in one basket. Dollar cost averaging. This is when you invest a fixed amount of money at regular intervals, regardless of what the market conditions is. It helps you buy more shares when prices are low and buy fewer shares when prices are high, ultimately reducing your risk of investing at market peaks. Set up dividend reinvesting, known as DRIP. Reinvesting everything and let compounding do its magic. In the end, if you're young, the risk is often worth the trade-off because time is your largest asset. So, is dividend investing a bad idea? Not always, but if you're young, it's not the best strategy. Sure, I get that dividend paying blue chip stocks makes you feel safe, and earning passive income sounds attractive. But when you have time, fewer responsibilities, and a stable career, it's best to gain more compounding and have more freedom later. If this video has helped change your views about dividends, please do me a quick 2-second favor and hit that like button and subscribe. On this channel, I regularly post content where I break down investing education and help you make smarter investing decisions. Also, don't forget to share this video with a friend or someone you know that is into dividend investing stocks, or anyone who needs to hear this perspective. Also, if dividend investing does make sense for you, then check out this video over here on top 5 dividend ETFs for passive income. And if you're into growth investing, check out this video over here on how to invest the right way in 2025. Thank you for watching. Until next time.